Index funds represent one of the most efficient, low-cost, and statistically proven methods for long-term wealth accumulation through the stock market. Unlike actively managed mutual funds, which rely on human portfolio managers attempting to outperform the market, index funds are designed to passively track the performance of a specific market index, such as the S&P 500, the Nasdaq Composite, or the Russell 2000. This means that when you invest in an index fund, you are not betting on individual stocks or trying to predict short-term market movements. Instead, you are buying a proportional slice of an entire market segment, gaining instant diversification across dozens, hundreds, or even thousands of companies simultaneously. The core philosophy behind index investing is rooted in the belief that markets are largely efficient over time, and that trying to beat them consistently is not only difficult but often counterproductive due to higher fees, emotional decision-making, and timing errors. For beginners, this approach eliminates the overwhelming complexity of stock picking and reduces the psychological burden of constantly monitoring investments. Index funds also tend to have significantly lower expense ratios compared to actively managed funds, often as low as 0.03% to 0.10% annually, which compounds dramatically over decades and can result in tens or even hundreds of thousands of dollars in additional returns. Additionally, because index funds are not frequently traded, they generate fewer taxable capital gains distributions, making them more tax-efficient in taxable brokerage accounts. Historically, the vast majority of active fund managers fail to outperform their benchmark indices over 10 or 15-year periods, further validating the passive approach. For someone just starting out, index funds offer a set-it-and-forget-it strategy that aligns perfectly with long-term financial goals like retirement, education funding, or generational wealth building. The simplicity, transparency, and mathematical advantage of low fees make index funds not just a good option for beginners, they are, for most people, the optimal starting point. To fully grasp the power of index funds, it is essential to understand their underlying mechanics and how they replicate market performance without active intervention. At their core, index funds are pooled investment vehicles, either structured as mutual funds or exchange-traded funds, that hold all or a representative sample of the securities included in a specific index. For example, an S&P 500 index fund will hold shares of all 500 companies in that index, weighted according to their market capitalization. The fund's manager does not make subjective decisions about which stocks to buy or sell. Instead, they follow a strict rules-based methodology to mirror the index's composition as closely as possible. This replication can be achieved through full replication, buying every stock in the index, or sampling, buying a statistically representative subset, depending on the size and liquidity of the underlying index. Because the fund's holdings only change when the index itself changes, such as when a company is added or removed, turnover is minimal, which reduces transaction costs and enhances tax efficiency. The net asset value of the fund is calculated daily based on the combined value of its underlying holdings, and investors buy or sell shares at that price, in the case of mutual funds, or trade them intraday like stocks, in the case of exchange-traded funds. Dividends paid by the underlying companies are collected by the fund and either reinvested automatically or distributed to shareholders, depending on the investor's preference. Importantly, because index funds track broad markets, they are inherently diversified, reducing unsystematic risk, company-specific risk, while still exposing investors to systematic risk, market-wide risk, which is unavoidable but historically rewarded over time. The structure also ensures transparency. Investors always know exactly what they own, since the fund's holdings must mirror the publicly available index composition. This mechanical, rules-based approach removes human emotion and bias from the investment process, making index funds one of the most reliable tools for disciplined, long-term wealth building. The long-term financial superiority of index funds is not theoretical. It is empirically proven by decades of market data and academic research. One of the most compelling advantages lies in cost efficiency. Because index funds require minimal management, their expense ratios are drastically lower than those of actively managed funds. While the average actively managed U.S. equity fund charges around 0.65% to 0.75% annually, many popular index funds charge less than 0.05%. Over a 30 or 40-year investment horizon, even a 0.5% difference in fees can erode hundreds of thousands of dollars in potential returns due to the compounding effect. For example, on a $10,000 initial investment growing at 7% annually, A 0.75% fee versus a 0.05% fee results in a final value difference of over $60,000 after 40 years, purely from cost savings. Beyond fees, index funds also benefit from lower portfolio turnover, which translates into fewer taxable events and greater after-tax returns, especially in non-retirement accounts. Studies from institutions like Morningstar and S&P Dow Jones indices consistently show that over 10-year periods, more than 80% of actively managed funds underperform their benchmark indices, and the longer the time frame, the worse the odds become for active managers. This underperformance is not random. It is structural. Active funds must overcome their higher fees, trading costs, and the difficulty of consistently identifying mispriced securities in highly efficient markets. Index funds, by contrast, accept market returns as fair and focus on capturing them at the lowest possible cost. Additionally, because they are broadly diversified, index funds reduce the risk of catastrophic losses from single-stock failures, a common pitfall for individual investors chasing the next big thing. The combination of low cost, broad diversification, tax efficiency, and consistent market-matching returns makes index funds not just competitive, but overwhelmingly superior for the vast majority of retail investors, especially those without the time, expertise, or emotional discipline to manage active portfolios. Selecting the appropriate index fund requires more than just picking the one with the lowest fee. It demands a strategic alignment with your financial goals, risk tolerance, and investment timeline. The first step is identifying which market segment you want exposure to. For broad U.S. market exposure, funds tracking the S&P 500 large-cap U.S. companies, the CRSP U.S. Total Market Index, entire U.S. stock market, or the MSCI USA IMI, including small and mid-cap stocks, are excellent starting points. For international diversification, consider funds tracking the MSCI World Index, the FTSE All-World ex-US, or emerging markets indices like the MSCI Emerging Markets. Bond exposure can be achieved through funds tracking the Bloomberg U.S. Aggregate Bond Index or global bond benchmarks. Once you have identified the asset class, compare funds based on 4 key criteria: expense ratio, tracking error, fund size, AUM, and liquidity. The expense ratio should be as low as possible, ideally under 0.10% for equity funds. Tracking error measures how closely the fund follows its index. Lower is better, and most reputable providers like Vanguard, iShares, or Schwab maintain tracking errors below 0.10%. Fund size matters because larger funds typically have tighter bid-ask spreads and greater liquidity, reducing transaction costs. Liquidity is especially important for exchange-traded funds, where you want to ensure you can buy or sell shares without significant price slippage. Asset allocation, the percentage of your portfolio allocated to stocks, bonds, international markets, etc., should be determined by your age, risk tolerance, and financial objectives. A common rule of thumb is 110 minus your age for stock allocation, but this should be personalized. Younger investors can afford higher equity exposure, 80 to 100%, while those nearing retirement may shift toward 50 to 60% stocks and the rest in bonds. Importantly, avoid overcomplicating your portfolio. 3 to 5 well-chosen index funds can provide global diversification across asset classes. Rebalancing annually or when allocations drift more than 5% from target helps maintain your desired risk profile. Choosing the right index fund is not about finding the best performer. It is about selecting the most efficient, low-cost vehicle that aligns with your long-term strategy. Getting started with index fund investing is far simpler than most beginners assume, and the entire process can be completed in under an hour with minimal paperwork. First, open a brokerage account with a reputable, low-cost provider such as Vanguard, Fidelity, Charles Schwab, or a commission-free platform like Robinhood or Webull, though the latter two offer fewer fund options. When choosing a broker, prioritize those with no account minimums, zero trading commissions on exchange-traded funds or mutual funds, and access to a wide selection of low-cost index products. Once your account is funded, even with as little as $100, begin by selecting 1 or 2 core funds to build your foundation. For most beginners, a U.S. total stock market fund, like VTI or FSKAX, and a total international stock market fund, like VXUS or FTX, provide instant global equity diversification. If you are investing for retirement, consider opening a tax-advantaged account like a Roth IRA or traditional IRA, which offer significant long-term tax benefits. When placing your first trade, decide whether to buy mutual fund shares, purchased at the end-of-day NAV, or exchange-traded fund shares, traded intraday like stocks. Exchange-traded funds offer more flexibility but require attention to bid-ask spreads. Mutual funds are simpler for automatic investing. Set up automatic contributions, even $50 or $100 per month, to harness the power of dollar-cost averaging, which reduces the risk of investing a lump sum at a market peak. Avoid timing the market. Consistency matters far more than entry point. Document your rationale for each fund purchase, not for market prediction, but to reinforce your long-term commitment during periods of volatility. Keep your initial portfolio simple. Complexity does not improve returns, it increases the chance of behavioral errors. Finally, enable dividend reinvestment, DRIP, to automatically compound your returns without manual intervention. The key is to start small, stay consistent, and let time and compounding do the heavy lifting. Your future self will thank you. Once your index fund portfolio is established, the real challenge is not analysis or stock picking. It is maintaining discipline, managing taxes, and avoiding emotional decisions. Rebalancing is the process of periodically adjusting your portfolio back to its target asset allocation. For example, if stocks have outperformed and now represent 80% of your portfolio instead of your target 70%, you would sell some stocks and buy bonds to restore balance. This enforces the principle of buy low, sell high mechanically without emotion. Rebalance annually or when any asset class deviates by more than 5% from its target, but avoid overdoing it, as excessive trading can trigger unnecessary taxes and fees. Tax efficiency is critical, especially in taxable brokerage accounts. Hold bond funds and REITs, which generate ordinary income, in tax-advantaged accounts like IRAs or 401ks, while keeping stock index funds, which generate mostly qualified dividends and long-term capital gains, in taxable accounts. Use tax loss harvesting strategically. If a fund declines in value, you can sell it to realize a loss, offsetting capital gains or up to $3,000 of ordinary income annually, and immediately reinvest in a similar but not substantially identical fund to maintain market exposure. Crucially, avoid behavioral pitfalls. Do not panic sell during market crashes, do not chase performance by rotating into hot sectors, and do not check your portfolio daily. Market volatility is normal. The S&P 500 has experienced intra-year declines of 10% or more in nearly every year over the past century, yet still delivered positive returns in the vast majority of decades. Automate contributions, ignore financial media hype, and focus on your long-term plan. Write down your investment policy statement, including your goals, risk tolerance, and rebalancing rules, and refer to it during moments of doubt. The greatest threat to your returns is not market risk. It is behavioral risk. Master your psychology, and your portfolio will thrive. Even with a simple, low-cost index fund strategy, beginners often sabotage their success through preventable errors rooted in misunderstanding or emotion. One of the most damaging misconceptions is the belief that you need to beat the market to succeed. In reality, matching the market with low fees and broad diversification is a winning strategy. Most professionals cannot beat it consistently, and individual investors almost never do. Another error is over-diversification. Holding 10 different index funds across overlapping asset classes adds complexity without improving returns and can dilute your strategic allocation. Stick to 3 to 5 core funds that cover global stocks and bonds. Many beginners also confuse volatility with risk. Short-term price swings are not losses unless you sell. Risk is the permanent loss of capital, which index funds minimize through diversification. Emotional timing is another killer. Selling after a 20% market drop locks in losses, while staying invested allows recovery. Historically, markets have always rebounded, though timing is unpredictable. Avoid performance chasing. Rotating into last year's best-performing sector or fund virtually guarantees buying high and selling low. Also, do not neglect bonds. Even young investors should hold at least 10 to 20% in bonds to reduce portfolio volatility and provide dry powder to buy stocks during crashes. Tax inefficiency is another silent return killer. Holding high dividend or high turnover funds in taxable accounts without considering tax implications can cost thousands over time. And finally, do not underestimate the power of small, consistent contributions. Waiting to invest a large lump sum often means missing years of compounding. The biggest mistake? Doing nothing out of fear or confusion. Start small, automate, and stay the course. Perfection is not required. Persistence is. Building lasting wealth through index funds is not about brilliance, timing, or luck. It is about consistency, patience, and unwavering discipline over decades. The math is simple but profound. Invest regularly in low-cost, globally diversified index funds, reinvest all dividends, rebalance annually, and never interrupt the compounding process by panic selling or market timing. Historical data shows that a simple 60-40 portfolio, 60% global stocks, 40% bonds, has never lost money over any 20-year period, and has often delivered 6 to 8% annualized returns after inflation. For younger investors, increasing equity exposure to 80 to 100% can enhance long-term growth, while those nearing retirement should gradually shift toward capital preservation. Automate everything. Contributions, reinvestments, and even rebalancing. Many brokerages offer auto-rebalance tools. Ignore financial news, market forecasts, and social media stock tips. They exist to generate clicks, not returns. Your portfolio success depends not on what happens in the market, but on what you do in response to it. Stay invested through recessions, elections, pandemics, and wars. Markets have weathered them all and reached new highs. Review your plan once a year, not once a day. Adjust your asset allocation as you age, but never abandon your strategy. Teach your children the principles of passive investing. This knowledge is one of the greatest gifts you can pass on. And remember, you do not need to be rich to start, but you do need to start to become rich. Whether you invest $50 or $5,000 per month, the principles remain the same. The miracle of compounding works quietly, invisibly, relentlessly, but only if you let it. So open your account, buy your first shares, set up your automatic deposits, and then do nothing. Let time, math, and the global economy work for you. If this step-by-step guide helped you understand how to start investing in index funds with confidence, make sure to like this video, subscribe to the channel for more no-nonsense financial education, and share it with someone who is ready to take control of their financial future. Drop a comment below. What is your first index fund going to be? Let us build wealth together, one rational decision at a time.